Joining us now from Capitol Hill with more insight into what the United States would look like under Powell is North Carolina Senator Thom Tillis, who is also a member of the Senate Banking Committee. Senator, great to have you on the show. Thank you for joining us. You must be pleased
Thank you.
with what Jay Powell said today.
I love the answer. The reason I love that answer, that's somebody who's coming through the committee, not someone who's been confirmed, but somebody who's seeking confirmation. So he gave a very honest answer, which is we have fleshed it out, the regulatory framework. What we need to do is figure out if we can improve the burden on financial services institutions by being clearer on who does the regulations and more efficient in the way that we apply the regulations to the business operations. We have a lot of financial services regulators that are coming in, overlapping with one another. And I think what Jay is trying to say is we've got enough. Now let's just execute them more efficiently and more effectively.
Why is Jay going to be better than Janet achieving that?
Well, I think that in the past we had so much, I think we had some muscle memory from the overreaction with Dodd-Frank. That there was a lot of words about trying to claw back or right-size the regulatory regimens, but I didn't really see that much evidence of it. It's been a frustration of mine for the nearly year that I've been on the Banking Committee, and before I joined the committee in January.
Senator Tillis, we talk about regulation in the abstract, but when you look at specifics and ways that the financial service industry is overregulated or rules that are perhaps inconsistent and need to be modified, when you look at the landscape, where do you see the most pressing need for change?
Well, I think you're going to see some of the most immediate relief coming next week when we begin to mark up a bill that changes the asset thresholds for certain regulatory regimens being applied. But there's still going to be a need to look at the nature of these financial services institutions, and some that have, let's say, assets of lower than $250 billion may necessarily, because of the nature of their business, have more regulations or more oversight applied to them, while some above shouldn't. And then we've still got to provide relief to the GSIBs, the larger financial institutions. It's absurd to me to think that a stress test or a CCAR, the result of that, a 100,000-page document, is a useful piece of information to pass from a bank to the regulators. There's got to be an easier, more efficient, more streamlined way of doing that.
So should there not be stress tests anymore? Should we cease that?
Well, I don't know that we should cease it, but we should also recognize that the industry standards are 3 or 4 times a year self-imposed stress tests. So to what extent could we have insight or transparency into those stress tests and that be instructive into whatever a regulator decides needs to be done to satisfy any concerns that they may have? It's those sorts of things. It's not turning a blind eye to the areas of banking operations that could have contributed to some of the problems with the financial crisis. It's a matter of doing it in the least intrusive way, because at the end of the day, these regulatory costs are not paid by the corporations. They're paid by people who have deposits, credit cards, and other financial institutions. That's why I have the motivation to try and reduce the regulatory burden, and hopefully in the process free up the flow of capital to people who simply aren't taking or are actually applying for loans right now.
Senator, I want to get your take on what's going on at the Consumer Financial Protection Bureau. There seems to be competing leadership bids for the agency or the Bureau, however you term it. How do you see this playing out? Because there is a lawsuit that has been filed and a court decision could be pending.
Well, I think that the president's position will prevail and that Mick Mulvaney will be take that acting capacity until we're able to confirm somebody. I think that they have a strong case to be made. I think it was a game that's being played by Cordray, and I don't think it's a game that he is going to win. I think that we will prevail and that Mick Mulvaney will be the acting head of the CFPB until we get a presidential nominee confirmed in Congress. Should
the CFPB still be in existence, or should it be shut down?
Well, I could see a lot of, if it continues to exist, first and foremost, it should seek appropriations from the Congress and it should come under congressional oversight. We should at least have that discussion and then figure out to what extent it needs to play a role versus maybe some of the things that the CFPB has expanded into could be embraced by the regulatory agencies. Maybe there's a reason to have them exist, but I think it needs to be looked at because I believe that it was a part of the overreaction to a legitimate regulatory exposure after the 2008 financial crisis. But I think it was an overreaction that reminds me a lot of the overreaction that we saw with Sarbanes-Oxley back after the Enron crash and the financial crash just after the turn of the century. I was a partner at Price Waterhouse at the time, and I remember how the demand for regulatory compliance resources came on because of all the regulation they had to deal with. So we have a full spectrum of regulations that we should go back to and just look at them from a reasonable standpoint. What risk exists that it exists to mitigate? Keep that on the books, but always ask yourself, can you do it in a leaner, more efficient manner?
Senator Tillis, before we go, I want to turn to tax cuts and the bill that is moving out of committee into the General Senate. It seems like it's going to have some provision that would trigger higher revenues if revenue in the future comes in below expectations or if the deficit is wider than projected. How do you feel about such a trigger?
I think that's problematic, and here's why. If I'm a business and I'm trying to make a long-term business decision, I have to assume a worst-case scenario, or at least heavily discount what would otherwise be a very positive outlook over 10 years if I know that trigger is looming. But to be honest with you, I'm not sure, based on the method that we're using to pass these tax reform measures, that it would even pass the so-called Byrd test, the way the triggers would be implemented. So it may be a moot point to the extent that it's not something that could fit within reconciliation. But even if it could, I'm not sure that we should. I think when you're talking about how heavily discounted we have projected the economic benefit of this tax package to be, I mean, we're talking about 40 basis points on GDP. I think it's going to be a lot more than that. So I don't think that we have to anticipate a crisis that's not likely to occur. I had these discussions in North Carolina when we were doing tax reform. Nobody's talking about having to raise taxes these days in North Carolina. They're talking about how to accommodate the business expansion that we've seen over the last 5 years.
Senator, if these triggers are included, does that mean you'll vote no to this tax package then?
No, I'd have to look at it. You're going to have to, there's a very high bar for me to vote no for this tax package because I really do believe this is a generational opportunity. We haven't done it since 31 years ago. I was even young back then. And now we're looking at maybe the last opportunity to do this. I think the market will react and react negatively, and we will not be in a political position to do this again for many of our political lifetimes. That's on us to fix. Now, look, if we make a mistake, or if we identify some things that need to be adjusted, we have a reconciliation bill next year. We'll still be in the majority while we have the time to execute that bill. We can try and adjust it. But I think there's so much good in this bill that the likelihood of the triggers will slow down growth a little bit, but I think it'll still fit within our 0.4% on GDP. I'd prefer it to be bigger because I've seen what aggressive, bold steps on tax reform will do in my own state.
Very quickly, what about an amendment or some kind of mandate to repeal the individual mandate? I've gotten my words mixed up here. Repealing the individual mandate. Excuse me.
No, you got it right. And actually, I like having it in there. I mean, I like the fact that it's three. See, we call it a pay for, but we should probably explain this to the American people. That $318 million or $338 billion is something that is a benefit to the American taxpayer. It's a benefit to the small business person. It is also derived from repealing a mandate for you to buy insurance.